Oil tankers sit idle off the Gulf Coast, their hulls dark against the water, waiting without purpose. Onshore, rigs still pump and workers still clock in, repeating routines that once meant security. Far away, prices flash downward on trading screens, numbers falling faster than anyone expected. Nothing looks broken at the source. Production continues. Infrastructure stands. And yet, the money is gone. The common belief is that Mexico's crisis in the 1980s was caused by mismanagement or foreign debt alone. A story of bad decisions and heavy borrowing. That explanation is comfortable because it places failure inside borders. But the contrarian truth is harsher and more unsettling. A single revenue shock exposed how fragile the entire system had already become. Think about that. Nothing was destroyed on the ground. No fields burned. No factories closed. Yet the foundation cracked anyway. Oil was not just another export. It was the backbone of the state itself. Budgets leaned on it. Social programs depended on it. Political promises were written with its expected income in mind. Oil revenue was treated as certainty, not variable. As long as it flowed, everything else appeared manageable. This is why the stakes were national. When oil income collapsed, it was not one sector that suffered. It was the state's ability to pay, plan, and govern all at once. Salaries, subsidies, debt service, and imports all depended on a stream whose value Mexico did not control. When that stream thinned, every obligation remained. The shock was psychological as much as financial. For years, oil had represented independence and leverage. It had given Mexico a sense of insulation from external pressure. Demand was global. Supply was domestic. The country believed it held a strong position in that equation. What it underestimated was how quickly prices could turn that strength into exposure. This story matters because it shows how dependence can turn abundance into vulnerability overnight. Oil did not fail Mexico because it ran out. It failed because it was asked to carry too much. When one resource becomes the answer to every problem, it stops being a buffer and becomes a fault line. Imagine the moment when the numbers first appeared. Revenue projections rewritten in red. Expected inflows revised downward again and again. Each adjustment forcing new questions. What gets paid first? What gets delayed? What cannot be covered at all? The crisis did not arrive as chaos. It arrived as arithmetic. Mexico did not lose control through invasion or sanctions. No external power seized its assets or dictated policy by force. It lost control through exposure. The price of its lifeline was set far beyond its borders, decided in markets that did not consider domestic needs. Once that exposure was revealed, there was nowhere left to hide. This is the central question driving the story forward. How can a country survive when the price of its lifeline is set elsewhere? When income depends on forces it cannot influence, planning becomes prediction rather than policy. And prediction fails when assumptions break out on the surface. Nothing seemed wrong at first. Oil still flowed. Contracts still existed. Export volumes remained high. The illusion of continuity delayed recognition of danger. But value matters more than volume. When prices fell, barrels became burdens rather than assets. The shock cut deeper because expectations had hardened. Commitments were made assuming stability. Debt was structured around future oil earnings. Programs expanded on the belief that revenue would remain strong. When prices collapsed, those structures did not adjust automatically. They resisted change. This resistance is what turned a price drop into a national crisis. Flexibility had been traded for certainty. Alternatives had been neglected. The economy looked diversified, but the state was not. Its fiscal core rested on one commodity and one price. Oil had given Mexico confidence and leverage. It also narrowed choices quietly. Other revenue sources mattered less. Other sectors carried less weight. When oil prices fell, There was no equivalent pillar to lean on. The imbalance revealed itself instantly. Nothing exploded. Nothing burned. The damage arrived through spreadsheets and contracts. Foreign currency inflows shrank. Obligations remained. The gap widened faster than policy could respond. The state faced a question it had postponed for years. What happens when the resource that secures everything no longer secures anything? This moment exposed a deeper vulnerability. Sovereignty depends not only on control over production, but on control over income stability. Mexico controlled its oil fields. It did not control oil prices. That distinction proved decisive. The crisis did not begin with default or panic. It began with realization. The realization that abundance had masked risk. That growth had been built on assumptions rather than resilience. That exposure had been mistaken for strength. Standing on the coast, watching idle tankers and active rigs, the contradiction becomes clear. The country was still producing wealth. It simply could not count on its value. In a system built on certainty, that unpredictability was fatal. This is not yet the story of collapse or recovery. It is the story of revelation. The moment when a system designed around one promise learned that promises priced elsewhere can vanish overnight. When oil stopped being security and became vulnerability, Mexico's crisis did not start with debt negotiations or austerity plans. It started when a single number moved against it, exposing how much depended on that number never changing. And once that exposure was visible, the rules of survival shifted permanently. This chapter opens a lesson written not in ruins, but in markets. When a nation builds its future on a price it does not set, it trades control for hope. And hope, when it breaks, leaves very little behind. Before the shock, Mexico looked confident and forward-moving, a country carried by momentum and expectation. New oil discoveries had reshaped how leaders saw the future. Fields once considered marginal were now strategic. Production climbed. Revenues surged. The state felt newly empowered, no longer constrained by narrow fiscal limits. State companies expanded rapidly, investing in exploration, drilling, and infrastructure. Pipelines stretched outward. Ports adapted to rising exports. Oil became more than an industry. It became the organizing principle of national planning. Everything else adjusted around it. Cities reflected this confidence. Construction accelerated. Public works multiplied. Roads, housing projects, and utilities expanded under the assumption that funding would remain available. Social programs grew broader and more generous. Subsidies softened daily costs. The state presented itself as capable, modern, and protective. Borrowing followed naturally. Future oil income appeared reliable enough to justify present debt. Loans were framed not as risk, but as leverage. Money borrowed today would be repaid easily tomorrow, once oil revenues matured further. This logic was widely accepted, both domestically and abroad. Institutions were built around this assumption. Budgets depended on projected energy exports. Debt schedules were aligned with expected inflows. Long-term plans treated oil income as stable ground rather than shifting terrain. The machinery of the state adjusted its rhythm to the pulse of energy markets. International lenders agreed with this outlook. Mexico's reserves and production potential reassured creditors. Oil-backed confidence translated into favorable terms and rising capital access. Bonds sold easily. Credit flowed. The country appeared integrated and respected within global finance. Imagine the atmosphere inside finance ministries during these years. Forecasts rose with each report. Revenue curves pointed upward. The belief was not reckless optimism. It was reinforced by years of high demand and global reliance on energy. Oil seemed indispensable, and Mexico was a reliable supplier. Oil gave the state leverage beyond revenue. It strengthened diplomatic standing. It reduced perceived vulnerability. It allowed leaders to promise stability in a volatile world. Energy wealth was treated as a shield against uncertainty. On the surface, the system worked. Money flowed in. Obligations were met. Salaries were paid. Debt service remained manageable. Confidence ruled because it was visible everywhere. From infrastructure projects to social spending, oil income left physical proof of success. This visibility mattered. It reinforced political legitimacy. Citizens experienced tangible benefits tied to the boom. Expectations adjusted upward. The idea that the state could deliver more became normalized. Oil revenue was not framed as exceptional. It was framed as permanent. Yet strength built on a single stream narrows choices. As oil revenue grew central, alternatives shrank quietly. Other tax sources mattered less. Diversification slowed. The economy looked broad, but the state's fiscal core was narrow. Everything leaned on one price. And that price was not under Mexico's control. Markets set it. Global conditions moved it. The state could influence production, but not value. This imbalance remained abstract as long as prices stayed high. Confidence delayed caution. The very success of the system discouraged hedging or restraint. Why slow down when demand looked secure? Why prepare for decline when growth appeared structural? The boom trained the state to expect continuity. This expectation shaped political behavior. Promises were made that assumed stable revenue. Programs expanded without built-in exit plans. Commitments multiplied. Each new obligation reduced future flexibility. But that cost remained hidden during good years. The illusion of strength rested on continuity. As long as oil prices held, the system justified itself daily. There was no visible signal urging restraint. Warning signs were statistical, not experiential, and therefore easy to ignore. The danger was not excess alone. It was concentration. When one revenue source funds too much, it becomes irreplaceable. Success turns into dependency. Dependency turns volatility into threat. Mexico's leaders did not see oil as a risk. They saw it as liberation from old constraints. In that belief, they were not alone. History is filled with states that mistook favorable conditions for permanent ones. This chapter matters because it explains why the shock was so severe. The system had been optimized for growth, not resilience. It functioned beautifully under stable prices. It had no room for reversal. Nothing in this phase looked like collapse. Institutions were confident. Scale was expanding. The machinery of governance felt secure. The illusion of strength was convincing precisely because it was real in the moment. But beneath that confidence lay exposure waiting to be triggered. When everything depends on one variable, that variable does not need to fail completely. It only needs to move. And when it does, the entire structure feels it at once. Mexico entered the next phase believing it had built stability on abundance. In reality, it had built certainty on assumption, and assumptions hold only until markets decide otherwise. The braking mechanism arrived without warning, carried on falling numbers rather than political decisions. Global oil prices collapsed, cutting deep into revenues almost overnight. Barrels still moved. Contracts still existed, but the value attached to each shipment shrank fast. What had once secured the state now undermined it. Obligations did not adjust. Debt payments remained fixed. Public spending commitments stayed in place. The state faced a brutal mismatch between income and responsibility. Oil revenue fell sharply, but everything built on it stayed the same. Pressure built instantly. Foreign currency inflows dropped as export earnings declined. That loss mattered beyond accounting. Dollars were the lifeblood of imports and debt service. As inflows weakened, confidence in the peso faltered. The currency slipped, making every dollar-denominated obligation more expensive in local terms. This was the turning point. Lower prices reduced foreign currency. Reduced currency weakened exchange rates. A weaker currency inflated debt costs. Cause and effect compounded quickly. What had been manageable at one price became unsustainable at another. Ask what happens when a government's income falls faster than its responsibilities. Choices vanish. Spending must be cut, but cuts take time and provoke resistance. Borrowing becomes harder, just as it becomes more necessary. Reserves drain as the state tries to bridge the gap. Emergency measures followed. Spending was trimmed where possible. New borrowing was sought under worsening terms. Negotiations replaced planning. The state shifted from managing growth to managing survival. Confidence, once assumed, had to be defended. Oil did not just lose value. It reversed leverage. What once reassured lenders now alarmed them. Dependence on energy exports, once a strength, became a risk factor. The same concentration that powered expansion magnified collapse. This was not a gradual adjustment. It was a shock transmitted through prices, currencies, and contracts at speed. Systems optimized for steady revenue amplified the fall. There was no buffer large enough to absorb it fully. International lenders reacted quickly. Terms tightened. Expectations hardened. Mexico's position shifted from partner to problem almost immediately. The change was not personal or political. It was mechanical. Markets responded to exposure, not intent. Reserves drained as the state tried to stabilize conditions. Each intervention bought time but reduced options. The room to maneuver shrank with every passing week. What had looked like flexibility during the boom revealed itself as fragility under stress. The system behaved exactly as it was built to behave. It magnified growth when prices rose. It magnified collapse when they fell. There was no hidden malfunction. The design itself produced the outcome. This moment revealed the cost of anchoring governance to a volatile stream. Oil revenue had supported everything, leaving little untouched by its decline. The fall did not isolate itself in one sector. It rippled across the entire state. Confidence evaporated faster than policy could respond. Planning horizons collapsed. Long-term projects were frozen. Decisions became reactive, shaped by immediate survival rather than strategy. The future narrowed suddenly. Mexico had not lost its oil. It had lost the certainty attached to it. And in a system built on certainty, that loss was decisive. Exposure, once theoretical, became lived reality. This was the moment when abundance turned into vulnerability fully and visibly. When a single price movement exposed how much had been placed on one assumption. The shock did not need time to do damage. It did so immediately, precisely because the system had no margin for error. The crisis was now unavoidable. Not because of one bad choice, but because many choices had assumed stability that markets withdrew without notice. Oil prices fell, and with them fell the illusion that revenue alone could guarantee control. The consequences reshaped an entire generation, spreading far beyond balance sheets and ministries. Austerity moved from policy papers into daily life. Public spending contracted. Projects stalled. Social programs that had expanded during the boom were cut back or abandoned. The promise of protection faded quickly. Wages fell behind inflation as the currency weakened. Purchasing power eroded even for those still employed. Ordinary citizens absorbed the shock through higher prices, reduced services, and shrinking opportunity. The crisis was not abstract. It was felt in households that had planned around stability that vanished without warning. The state retreated from commitments made during years of confidence. Subsidies were reduced. Guarantees were withdrawn. The social contract was rewritten under pressure. Trust, once anchored in visible delivery, fractured as expectations collided with limits. Oil remained in the ground, but its political role changed forever. It no longer symbolized security. It represented risk. Revenue projections were treated with caution rather than certainty. The resource that had anchored policy now forced restraint. Restructuring followed. State roles narrowed. Assets were privatized. The government adjusted not by choice, but by necessity. Control gave way to accommodation. The crisis did not destroy institutions, but it reshaped them toward caution and constraint. Debt negotiations left lasting marks. External conditions influenced domestic policy more directly. Sovereignty felt conditional, tied to credibility rather than capacity. The shock had revealed how quickly leverage could reverse when confidence evaporated. In the long run, Mexico's experience became a lesson written in balance sheets rather than ruins. Resource wealth can stabilize a country, but it can also trap it. When budgets depend on volatile prices, planning becomes fragile. Stability becomes borrowed. The modern relevance is quiet but clear. Many states still anchor finances to commodities they do not price. They build promises on assumptions shaped elsewhere. Mexico's shock showed how fast confidence can turn when those assumptions break. Nothing exploded. Nothing burned. The damage arrived through numbers and contracts. Oil prices fell, and with them fell the certainty that had held the system together. Exposure became reality, and reality demanded adjustment. Mexico did not collapse. It endured, adapted, and learned at great cost. The crisis forced recognition of limits that abundance had obscured. It demonstrated that sovereignty is not only about resources, but about resilience to volatility. This story ends not with ruin, but with warning. When a nation builds its future on a price it cannot set, control becomes conditional. Revenue that feels permanent can vanish overnight. And when it does, every promise built upon it is tested at once. If this examination of how abundance becomes vulnerability sharpened understanding of modern economic power, now is the moment to subscribe and share, so these lessons remain visible in a world still tempted by certainty that markets never promise.